All right, good morning, guys. Real quick, I wanted to make this video for you. This basically came to my attention when I was talking with my neighbor, and you know who you are. Yesterday we were talking, and basically there were 6,000 shares that you have bought, and this goes for anybody. Okay, let's say right now stocks are kind of going down. You don't really know what to do. And I always stress to people there is actually ways to make money on a down market. And that's the whole sole purpose of this platform, the InvestingOnDemand.com, the InvestingWithChris, and then the YouTube, and basically all these videos that I make for you guys. So we got into, stock options and everything else like that. And it is still coming along. Hopefully I've taught most of you the basics and you're starting to understand that. But the thing with stock options is that they are very complex. Okay, you can sell puts, you can buy puts, you can sell calls, you can buy calls, you can do this, you can do that, get in the same call option and get out at a different strike price, and it's still, you basically, there's a lot to learn. But hopefully I can make this video make sense for those who own shares, at least 100, because remember, every 100 shares that you have, you can actually sell a covered call with, because stock options are theoretically the same position of 100 shares just with less capital. So one option contract equals 100 shares. I don't know how many times I can stress that. So we were talking, and I think that he has about 6,000 shares, and he's basically just sitting on them, not knowing what to do until hopefully Blink goes back up. But here's something I really looked into. And I'm over here at the 36 days, right? 36 days that I can hold on to this contract. And I can't remember the actual purchase price that he got into. But let's just say that it's dropped. For instance, you got in at 7.5. You have 6,000 shares. And now it's down to 6.5, 6.6. Well, the thing that you can do while you're waiting, and even do this every single month, depending on where your break-even price is sell contracts or covered calls on those shares. So if we take a look, 6,000 divided by 100 gives us 60 contracts that 60 contracts that we can actually write and sell. So let's take a look at this. Let's say our break even just so happens to be 7.5, and in the next 36 days it could go up or it could go down, or if it just stays the same, what can we do? We can actually make money with it not even doing anything. It can sit right here and we make this amount. So I'm going to move this thing up to 60, and this is going to give us, I'm going to move this slider. Always like when I sell premium or sell covered calls, if I sell puts, I like to move this all the way up, because when you sell something, you want to sell it for the highest amount. When you buy it, you want to slide this over to the lowest. So you can write that down in your notes. When you're buying options, you want to slide this slider in your Thinkorswim platform down to the lowest natural as you can be, and then drop down to whatever price that you think that you could get out of it. Right here, I could well, I'm selling, but if I was buying this, I could buy it for 75. Even though the slider only goes down to 85, I can move this down, and this is about the expected Blink price for me to be able to get that out of. But since I'm selling, I want to move this up to 90. The width of the strikes is 85 and $1, but let's just go 90. I could try to get $1 out of it, but the Blink is going to it's going to have to go up some. Now these width of the strikes, remember, this is what the market makers, how they make their money. There's a $15 difference right here. So the system's only let us go to 90 because there's an extra 10 cents here that the market makers are playing on. But let's go to 90. Okay, so I put in 60 contracts because that's what we're allowed with a $6,000 position. And we're writing this for just a little over a month, 36 days. So we hit confirm and send, and look, $5,400 that you can make, and this is guaranteed. Okay, and I say that because if you sell this contract, you get the $5,400 And depending on whether or not you leave it at that, walk away from your system and never return for another 36 days or on that 37th day, it expires and you're netted that. Now, if it breaks over 7.5 or maybe it goes to 10, you still wrote that contract for the 7.5. So you let those shares go away at that strike price. Or if the stock drops down, you still take in $5,400. Now, your shares that you have of 6,000, it goes down on the long side, but you recouped some of that loss, or you hedged that loss with this covered call strategy. I don't know how many times I can stress to you guys, before you ever buy stocks, you want to sell puts against it, because the worst thing that it does is go down to that strike price and you still hedged into that position with a lower buying price because you took in premium of a lower strike price of that stock that you was already interested in. Now the flip side is, once you own 100 shares or more, then you want to flip to the call side and start selling 1 strike out, 2 strikes out, whatever the case may be, of a covered call onto those shares. Because now you're making money regardless if the stock goes down. Anyone in the stock market can buy a stock and hang on to its shares. What you do with it is the financial understanding, the financial investment of how to make your money work for you. And that's the sole purpose of this channel, and the sole purpose of what I'm trying to educate to you guys is there's this thing called stock options. So if I was just holding on to shares, I have to make money by those shares going up in value. But what happens when they go down? That's where the difference between smart investors or educated investors get the upper hand on those who are just holding onto their shares and not really knowing what to do with those in a down market. So here we go. Like I said, we sell puts when we're looking to get into that stock. Because if I was looking to get in this stock right now, I could go ahead and buy it at the 6.6. But guess what? I'm buying it. I want to make money. So if I think, hey, if I want to get into this position, I'm already going to buy 6,000 shares worth. Why don't I just sell 60 puts? Because remember, that's 6,000 shares worth, 60 options, because 60 times 100 is 6,000. And I move this up to about 60. If the stock drops down to 5, it then gets assigned to me. Now I own the 6,000 shares, but in the meantime, I'm taking in $3,600. And now my break even, here's where the system lets us know what our break even is 4.4. So now instead of buying at 6.6, and that's my break even, now my break even is down to 440. And I just took in $3,600. Now if the stock doesn't drop down to 5 in 36 days, guess what? I just took in $3,600 worth of cash. And I'm not obligated at anything. I just took that money in. That's mine. I invested with selling puts. Now, all my money is pretty much wrapped up in the position, so I can't get into this. But would I do this position? I would definitely think about it because the implied volatility is high. And when implied volatility is high, and you're going to want to write this down again, that's when you're selling options, when the implied volatility is high, because there's usually no more room for it to go. You can buy that back cheaper when the implied volatility drops. And then on the vice versa, when implied volatility is low, that is typically when you see option buyers, either buying puts or buying calls. But so this is favorably pretty high, 169%. That's a good implied volatility. It's high. It means there's a lot of apparently demand for it. Or the option is just really volatile, or the stock itself. So would I get into this position? Most certainly. And I just gave you guys an opportunity of how to make $36 every 36 days. Now, the risk, it says max loss right here, and I've stressed this numerous times of what this means. It's not your max loss. You're not betting $3,600 for a max loss of $26,000. You're making $3,600 regardless. If it drops down to that strike price, the 5, then you assume the stock at 440, or that's your break even. You assume the stock at 500 or 5, sorry, and it will cost you $26,400. Now you're in a position that would normally be at the 5 at 6,000 shares, now only for $26,400. So your portfolio should and better have $26,000 worth to cover that position. And typically, Thinkorswim will not let you. As you can see, I don't have that liquidity right now, so this is why it's not letting me get in this position, because it's saying illegal. So if I did have it, I would make $3,600 regardless, unless I want to buy back the position depending on what it does and then get out of it. But if I wanted to for sure get into this at 5, I take in $3,600. If it drops down, now I have to give up $26,000, and I buy that. That's not giving up. You're not losing it. Now you obtain an asset, you obtain that stock, and that's how much it cost you. And now this is your break even. So then you would go over to the flip side of the call options, and you can see what you can sell 60 contracts for. Okay, this will more than likely be the same price in 36 days. So we can just guesstimate. Okay, it won't tell us what the future value will be, but we can assume that this chain in 36 days will look like this, and these stock prices will look the same. We just have to understand we're going to be into the stock at 4.4, and then say, for instance, we want to sell a 10. Okay, I'm going to show you, for instance, we have $26,000 worth of shares at 4.4. We've taken in $3,000 already. We lowered our break even. Now we can mess with the 5 or the 7.5 or the 10. For instance, let's do the 10. Let's sell 60 shares at the 10. What that's going to do is it's going to give us some safety, the 4.4 and the 10 split. So that means I can sell this for 60 contracts and make right away $2,700, $2,700. Okay, now you're going to ask me, what happens if it goes up to 10? Guess what? You take the difference plus the premium, and that's your profit. So the $26,000 that you had to buy for the 4.4 strike price at 6,000 shares now goes up to 10. Now those shares are $60,000 worth. So 26,000. Well, it was around 26.4. Subtract 10,000. I'm doing this the opposite, and I know it's going to show a negative. Or no, actually it won't. Sorry. Is $16,000 in profit plus the 2,700, because you're letting go of your shares at the 10. You wrote that contract, and now someone takes obligation, and the system will give you the difference between the 4.4 and the 10. Wow. Why haven't you guys been selling stock options before I've had to tell you? Because I always say, we don't know what we don't know. Now, hopefully that helped. I'm going to show you my Boeing, what I'm doing with Boeing, to give you a little bit more example. Okay, so let me close this out. I'm in one position of Boeing. I've been doing this for about 2 months, maybe a month. I've probably made anywhere from $1,200 to $1,300. It's cost me the same theory. What I've done is, instead of buying shares, I went long, which is called a poor man's covered call. Okay, it shows that I'm in my position of 491 days. I think I had 570 or 550. I don't remember the original. I can always go back in my system and look. And I bought this thing, this 110, for $9,000. Well, now it's only down to 6,800. And I say 6,800 because I'm in one position. So 100 times 68 is the 6,400 or 800. So it just dropped. Oh, there it is. Sorry, I'm looking at the wrong strike price. So it cost me $9,000, but in return, I'm selling contracts at either 244, 900, whatever my break even was. At the time, it was 205, but I've shortened that because guess what? I've taken in money. So now I paid that $9,000 off. I basically brought it down to a lower break even, and I get to sell every 36 days for about 290 here, 240. But here's the thing. As Boeing keeps dropping down and down, I can buy back these options for a lot cheaper because guess what? They then decay. They drop lower. So I get to buy them back and profit and hedge into profits that way. And then the next day when Boeing goes up, then I just move my strike price. I look at my different things here and I get into a different strike price. And then if it drops, then I buy it back and I scalp in more profit. Or I can let it expire and take in the full amount as long as it doesn't bust over the strike price to which I paid for it. Now I'm very conservative, and what I do is I always do my math, I check my break even, and I sell at that strike price. Some people get a little bit of risque and they want to sell at 175. Well, if my break even is at 190 and I'm selling at 175, okay, I'm taking in 400 here, but if it breaks 175, I have to let go of that long contract, and I'm now shorted, or the difference between the 19,000 and 17,000. So now, is that going to cover my loss between the two strike prices, or the two prices I have to let Boeing go away from, if that makes sense? So it might not be very feasible to me to go and get risky when I can automatically make 192, and I know that's my break even, so I'm making that regardless. Some people can get a little bit more risky, but you're not guaranteed that it won't bust through that. Now, there's a lot of other things I look into, and this will be another lesson, but I always mention this top right-hand corner, and then I compare the delta. This top right-hand corner is saying that there's 63.29% that this Boeing could go plus or minus 20. Well, that exceeds the 170, 172 range. Then I look at the delta. Okay, well, the delta is pretty much close to my probability of hitting this strike price. So there's the 37% here, and then up here the system is giving us 63% chance of going plus or minus. So it's a little bit, it could or could not, but I always like to hit these 18s, these 10, these 9s, because that means there's only a 9% chance of going up to 205. But I definitely do my break evens. That way I get a little bit more. If I want to take in a little bit more profit, I may bump that up to a closer or lesser break even. But I always make sure I hit my break even, because if the stock happens to bust through that, at least I know I'm still getting the premium. Then I let my shares go at that price, and the difference between whatever I'm at, I paid that $9,000 off to here, will basically be paid off, and then I take in the extra 150 for sure. So that is 150. So I stress break even to go ahead and pay that $9,000 off, and then I will get this 134. Now, as I said, I have made money about $700 to $1,200, so I can lower that $9,000 break even. Do the math, and now my strike price to which break even between this and that becomes a little bit lower. So then I can sell lower and lower and lower. And so as this thing drops down the price, I can sell in these amounts if Boeing continues to drop. Now, of course, that long covered call drops in price, but remember, I'm hedging down and paying the $9,000 off. The hopes and the mission or the goal here is to pay that $9,000 off as quick as I can with this premium, and now I'll own Boeing for free, and then I can just start selling covered calls. This was a lot of information. I want you guys to please do two things. I want you to check the InvestingOnDemand.com website. It looks like this. It kind of looks like a Netflix or whatever you want to call it. It is video on demand. And then I've also got Investing with Chris over on YouTube. A lot of content goes up every day on both of these websites. This website does come with a $1 cost, and that's just to make you guys take it serious, that know in the back of your mind, hey, I'm paying $1, I'm going to make use for this, and I'm really going to pay attention. There's also an exclusive podcast that myself and Carlos is doing. That is only available here on the Investing on Demand. That talks about crypto. We go into that real quick, and it is called The Crypto Show with Chris and Carlos. And the website should pull it up pretty quick. If it's not, should. Yep, so here we go, The Crypto Show. We got 2 episodes, guys, security issues and tips, and then coffee and crypto talk, where we gave a lot of good information about crypto investing and what's to come with that. So, as always, make sure you subscribe. Check out InvestingWithChris.com, InvestingOnDemand.com, and I'll see you next time.